Hi, welcome back. In my last post, I looked at CAPE or Shiller PE as a predictor of market timing and found it wanting. And that post got a whole lot of reaction, some of it good and some of it in disagreement. And that's perfectly okay. That's exactly the kind of debate we should be having about market timing. The disagreement, though, centered on two issues. One was measurement issues. For instance, why did I look at just 1 year and 5-year returns? Why not 10-year returns, which is where it's supposed to be strongest? And the other was on how I was reading my numbers. In fact, as one person put it, the whole idea behind CAPE is not to time markets, but to get messages about future returns. And if the CAPE is high today, expected returns on stocks in the future will be low. I'll come back and address both of those. These are legitimate questions. But there was a third issue that I was surprised did not come up more often, which is the whole idea that the CAPE should revert back to a historic average. This, of course, is what's called mean reversion. It's amazing how much of investing, especially of the value investing stripe, is built on mean reversion. When you buy a stock with a low PE, you're effectively assuming mean reversion, that PE will revert back to the average PE for the sector. And mean reversion lies at the heart of so much of what we do that I thought it's worth some attention because I think it does get us into trouble sometimes. So let's talk about the essence of mean reversion. In statistics, mean reversion was first officially discovered. I'm sure unofficially people knew about it well before that, when a British statistician, Sir Francis Galton, looked at the heights of parents and the children they had. And what he noticed that was even when parents were abnormally tall or abnormally short, their children tended to revert back to an average. Mean reversion. And he established, and in fact, what he did was the basis of regressions and statistical regressions, because it talks about that idea that the average acts like a magnet pulling you back. In markets and investing, mean reversion has taken on a much stronger role than in almost any other discipline. For instance, if you've read Jeremy Siegel's work on stocks, and he argued that stocks win in the long term, that's built on looking at US data going back 200 years and noting that over those 200 years, not only did stocks do much better than bonds or T-bills, but that there was no 20-year period in his history where stocks underperformed the competition. Hence, he says stocks always win. That's mean reversion played out. Or when you, as I said, buy low PE stocks or low price to book stocks, you're effectively buying into mean reversion. I'll make a confession. I use mean reversion all the time in intrinsic valuation when I assume that the margins for a company revert back to industry averages, or that the cost of capital for a company will move towards an industry or a market-wide average over time. So we all use mean reversion. So this is not just about pointing the flashlight at what other people are doing, but pointing the light just as much at what I'm doing, and perhaps getting more honest with myself about what mean reversion is about and what it accomplishes. Now notice though that not everybody buys into mean reversion in markets. Almost every thought has a counter thought. Every point of view has a counter point of view. And the counter to mean reversion is this time is different. And before you dismiss it too much, the notion of momentum investing is often built on the presumption that things, when they start moving, even when they're moving away from the mean, will keep moving in the same direction. Now, can both of these people be right? Both groups be right? One group believing that things revert back to the mean and the other group believing that things can move away from the mean? Well, the answer is yes, because it depends on your time horizon. Maybe things move towards the mean over 10 years, but not away from the mean over the next year. And worse still, both sides can be wrong. So I want to kind of look at the foundations of mean reversion and what it means. There are two ways in which investors can draw on mean reversion. The first is time series mean reversion. We assume that things revert back to a historic average. That, after all, is what we're doing when we use PE or Shiller PE to argue that stocks are overpriced today at 27 times earnings or 25 times earnings because the historic average is 15 or 16 or 18. The other is cross-sectional mean reversion. This is what we draw on when we buy a low PE stock in the steel sector, expecting that PE to revert back to the average PE for the sector. Now, they both have their own sets of assumptions and own dangers, but it's good to know what kind of mean reversion you're assuming. At the risk of overgeneralizing, when market timing is primarily based on time series mean reversion, whereas stock selection, where you try to pick, or fundamental analysis, is usually based on cross-sectional mean reversion. Now let's talk a little bit about the big questions and the small questions in mean reversion. Broadly speaking, there are two ways in which you can frame questions on mean reversion. The first are what I call the small bore questions, measurement questions, where you can have questions about both the mean and what exactly it means. And you're going to see very quickly when I show you the numbers that we might both believe in mean reversion, but what the mean is can be very different depending on how we measure it. The second is the reversion part, and there the debate is about how quickly it will happen, and that has consequences for time horizons, and in what form. And I'll use CAPE to kind of illustrate both of those issues. In the case of CAPE, for instance, if you think about the Shiller PE or CAPE, and you say, I'm going to assume mean reversion, that mean is about 16 if you go all the way back to 1871, but it's about 25 if you go back to 1997. So already you can see that even though we might both believe in mean reversion, that mean can be very different depending on the time period we look at. It can also be different in how we compute the mean. You can compute the arithmetic mean, which is adding up 20 numbers and dividing by 20, or we can compute a median if we think that there are too many outliers in the process. So even on that very simple question of mean and the mean reversion, you can see there can be differences about what that mean is. Let's talk about the reversion part. Let's say we both agree that there's mean reversion in the PE and that the PE today is 27, that we think it'll go back to 16. You think that we're now on the same page, right? Not necessarily. And here's why. If I think it's going to take 10 years and you think it's going to take 2 years, that's very different in terms of the investment strategies we can put into place. The other way also that PEs can move from 27 to 16, and one, the price can drop, which is a bubble bursting, or it can be earnings increasing over time. Again, very different consequences for investing. So even though we might believe in mean reversion and agree on it, you can already see there can be measurement questions that set us apart. But there's the elephant in the room, as I said, the big question that underlies mean reversion. Mean reversion works if you have a process that is stable and hasn't changed over time. You can have a lot of volatility in the process as long as the underlying process is stable. You think, what does that even mean? If there's been a structural change in the process, then mean reversion will not work. So let's talk a little bit about structural changes, because to me, this is the weakest link in mean reversion. When you're doing time series mean reversion, structural change can happen for any number of reasons. One is, of course, the aging of a company, a sector, or an entire market. For instance, if you're a sports fan and you have an aging sports star on your team, you can assume that sports star is going to revert back to his historic norm, but that's a dangerous assumption because as he ages, his capacity to play is probably also going to drop off. The same thing can be said about companies. A company that's young might be able to grow at 30% a year, but as it ages, that growth rate is going to drop off. You're not going to revert back to historic norms in terms of growth rates, in terms of risk, in terms of cost of capital. Now, with sectors, as a sector ages, again, you're going to see the fundamentals of the sector change, assuming things will revert back to the way they used to be when the sector was a young and a growing sector, can be phenomenally dangerous. And for an entire market, can this happen? Sure. You could actually argue that the US in 1871, which is the starting point for the Shiller CAPE, was an emerging market. The US in 1900 was starting to make its place, but it wasn't the biggest market in the world. The US in 1945 was the center of the global economy. So even in the 1871 through 2016 time period, you can see a market like the US aging, and as it ages, its characteristics are going to change. In what direction? Still to be examined. You could have technology shifting, causing this, and in the US, this is a very direct consequence as tech companies have come into the S&P 500. We can argue about whether tech companies are fairly priced or not, but here's one reality we cannot run away from. The accounting of earnings for tech companies is very different than the accounting of earnings for manufacturing companies. And here's why. With manufacturing companies, capital expenditures are treated as capital expenditures. They don't show up as operating expenses. With tech companies, the biggest capex is R&D, and accountants treated as an operating expense. So you can actually argue that holding all else constant, the PE ratio for the S&P 500 should be higher now simply because of the composition of the sector. And investor preferences could change over time. people have talked about how index funds and passive investing is a much larger segment of investing than it used to be. Maybe that has consequences for PE ratios. Maybe tax rates change over time. So if you have a time series mean reversion, your changes can come from any of those. When you're talking about cross-sectional mean reversion, you have to be careful about assuming that things revert back to the average if there have been changes in the industry structure. Maybe it's becoming more competitive, in which case margin should decrease over time. Maybe it's getting less competitive, margin should increase over time. And the essence of disruption is you can have a new entrant who doesn't play by the same rules as everybody else. So in valuing Tesla, this was a big struggle. Should I be looking at the auto industry margins and capital expenditure in valuing Tesla? And the answer might be no, it's a very different company. So if there's a structural change, you have a problem with mean reversion, and that's a question we should constantly stop and ask ourselves. Has there been a structural shift that I should be worrying about in my zeal for mean reversion? So let's talk about the structural shift in the US equity market. If you look at the top of this page, you actually see two pie charts. The first pie chart, which is kind of tough to read, but if you kind of use a magnifying glass on it, you could probably take a look at it, looks at the US equity market composition in 1900. That's part of the Shiller database, right? Do you know that in 1900, 62% of the market value of US equities came from railroads? No surprise that was the growth engine for the US economy then. 62% of the market was railroads. Now look at 2015, much more diverse, very different. So the market has changed pretty dramatically, even in that long time period where we have for US stocks. And that change in the market reflects changes in the economy. As I said, in the post-Civil War era, 1871, the US was more emerging market where the growth and the potential was than developed market. By 1945, it was the center of the universe. And you could argue that by the 1980s and 90s, you're starting to see that shift away from the US to a more global economy. So all I'm trying to say is when we use that 1871 through 2016 database and assume no structural changes, we might be making a pretty serious assumption. But let's set that aside. Let's assume we buy into this. I think, 2008 should have been a wake-up call. It at least was for me. And it was a wake-up call on three levels. First, it told me that globalization was not just a word, it was here to stay. Investors were globalized, companies were globalized. In fact, companies that get all their revenues from just the domestic market have become the exception rather than the rule. So globalization is here to stay. We're all connected at the hip. Everybody's crisis is everybody else's crisis. Second, 2008 led me to lose faith in financial service firms. That's a post waiting to happen. We all lost faith in banks. We used to think that banks were solidly run enterprises that were well regulated. No longer. And that's led to some perverse consequences. We've actually put more faith into central banks to get us out of this. And guess what? The central bankers have obliged. And we now, and in a strange way, they might have created the opposite of what they hope to create, which is low growth economies with high risk premiums in their zeal to push down rates. I don't know whether they're the ones responsible, but in the process they've created this low growth, high risk premium world. And that low growth and low inflation that they've created has also meant that interest rates are at historic lows. So in a sense, even if you believe that things would revert back to the way they used to be until 2008, I think you might need to rethink that assumption post-2008. At least it led me to rethink it. Now, if you look at the statistical basis for mean reversion, and that's how most mean reversion is shown, is they show you the past, they show you a lot of data. And with CAPE, for instance, all you need to do is look at this graph to see the basis of the mean reversion argument in CAPE. This is actually the Shiller CAPE going back to 1881. See the CAPE each year. I've also superimposed on the Shiller CAPE the median value for the Shiller CAPE over the previous 25 years. And I've calculated how different the actual CAPE is from that median. So what you're seeing in this graph are three separate lines. One captures how much the actual PE each year. The second captures the median value. And the third captures whether the PE looks high or low relative to the median. And you can see, even with this very simplistic graph, that things seem to revert back to the way they used to be. You're saying that's pretty weak rule. You want something stronger? Well, this is the way, in fact, you see most CAPE advocates present why it's such a great market predictor. It's a scatter plot of what? Of the CAPE today, the PE today, against the returns on stocks over the next 10 years. I've taken the strongest possible case you can make for CAPE. And you can see that when the CAPE is high today, returns tend to be low. And when the CAPE is low today, returns tend to be high. It's a scatter plot. You're saying, well, that's not very good. Show me some actual numbers. Okay? So that's where correlations come in. And you can see again, as I go to 1 year, 5 year, and 10-year returns, the CAPE starts to get better and better at predicting returns. So by the time I get to 10-year returns over the next 10 years, the correlation between the CAPE today and that number is minus 0.5. You're saying, what does that even mean? The higher the PE is today, the CAPE is today, the lower the returns are going to be over the next 10 years. Still not convinced? Well, let me cement the deal. I ran regressions of returns over the next year, the next 5 years, and the next 10 years. And this is going back as far as I can against the CAPE today. So here's what you're looking for. First, you're looking at the R squared, and not surprisingly, you see the same results you saw with correlations. The R squared tends to rise as I go from 1 to 5 to 10-year returns. The second thing you're looking at are the coefficients in the CAPE. Notice they're all negative, so the higher the CAPE today, the lower the expected returns. I should have reported t-statistics, but you have to take my word on this, but the t-statistics was significant. These regressions passed the statistical significance test. You see, what do I do with this? Well, let's take the CAPE today. It's about 27.27. If I take the 10-year return regression and plug in that 27.27, I get an expected annualized return for the next 10 years on stocks of 4.3%. That's scary low, right? Before you freak out though, remember that there's going to be because the R squared is only 32%, there's going to be a range around it. It could be as high as 7, as low as 1. But if you buy into this regression, the next 10 years are going to be years in the wilderness for you if you invest in stocks. And this is the basis for many people now telling you that based on caps, stocks are overvalued, that you should either stay out of stocks or worse still sell the stocks you have. Now, there are ways in which you can read that CAPE which are not which don't create those actions. You could just basically say, I'm going to use it for information in terms of how much I need to save for the future. That's fine. I can live with that. But if you're using it for market timing, you're actually using it on a much tougher test. So if you decide to use these statistics and base a strategy on it, you have to start to get specific. Specific about what? First, you got to tell me what your threshold is. So I've given you the relationship between CAPE today and returns in the future, but if you're going to use it for market timing, you need to tell me at what level of the CAPE would you start acting. Would you start acting the minute the CAPE goes 25% above the median, 50%, 75%, or the higher you set that number, the fewer times you will market time. The second, you got to tell me what your alternatives are. So if you decide to take your money out of stocks, where are you going to put it? Into T-bonds, into T-bills, into other asset classes? Third, you got to tell me how long you will hold stock. So let's assume you decide to market time. Are you going to market time for a finite time period that's set up front, 1 year, 5 years, or until the PE reverses itself? In other words, if you sell stocks when the PE is 25% higher than the median, will you hold on to stock? Will you stay out of stocks until they drop below the median? So you have to make that pretty specific. And finally, you got to tell me what exactly your timing will involve. Let me be specific. Let's assume that the right mix for you, given your risk preferences and your liquidity needs, is 60% stocks, 30% bonds, 10% T-bills. So that's basically, let's say, your preferred allocation mix. The essence of market timing is that you will move away from that mix. So you will use the CAPE or the PE or whatever your market metric is, and if it tells you that markets are overpriced, you will lower the 60% in stocks to 40 or 30 or 20. And you got to tell me whether you will go below zero. What is going below zero? If you think stocks are overvalued, would you be willing to sell short? So that's what I mean by allocation constraints. At the other end, you can go from 60 to 80 to 100 if you think stocks are underpriced, but will you go above 100? What does that mean? You're borrowing money to buy stocks. So again, you got to be specific about your timing strategy. Why do you have to be specific? Well, without a specific timing strategy, I really cannot test whether it actually delivers returns. So as an example, here's what I did. I took a 60-30-10 mix as my starting point. I used a 50% threshold. In other words, the PE had to be 50% higher than the median for me to sell, and 50% lower than the median for me to buy. And I also assumed that when I bought, I went from 60 to 80%. I would increase my stocks from 60 to 80, and when I sold, I'd go from 60 to 40. It's a very specific timing strategy, and with that timing strategy, here's what I found. Over the 100-year time period, and here's good news if you're a market timer, I would actually have earned about $54,000 more with market timing than without market timing. You think, this is good, let me go time markets right away. Here's the bad news. All of those returns came in the first 50 years of this time period, 1917 through 1966. If you look at 1967 through 2016, the payoff to market timing is negative. Now you're saying, well, maybe it'll go back to the way it used to be. But and the other issue you can take is why the specific choice you made. Why 50? Why not 25? Why not a lifetime Cape? Why 80-40? Why not 100-0? That's why I've left the spreadsheet for you to try out your own market timing strategy, because here's what I found playing around with the numbers. I found that no matter how I sliced and diced my market timing strategy, the first period, I had a positive payoff. Second period, I had a negative payoff. That was independent of however I set up my strategy. Second, I discovered that changing my lifetime for a median from 50 years to to the entire lifetime delivers better results during the good period and worse results during the bad period. And using a shorter time, say 25 years, reduces my outperformance in the first half but improves it in the second half. In other words, it just magnifies whatever problems I had. So using a lifetime magnifies both the good side and the bad side. Using a shorter time period reduces both the bad and the good. I also discovered, and this was interesting, that the payoff to using CAPE as a buy mechanism is almost all of the payoff from market timing is coming from the buy that comes out of CAPE rather than the sell. In other words, when I buy stocks because the CAPE is low, I make almost all of my market timing money. Using CAPE as a selling tool has delivered no returns in either of the time periods. So that's interesting. It's the more effective as a buy tool than a sell tool. And finally, changing that 80-40 to 120 to 100. So selling short, borrowing money. Really, all it did was magnified both the positive and the negative. It made my good period, the first 50 years, better. It made the bad period worse. So if you believe the last 50 years are reflective of what's going to happen in the future, becoming more active is only going to harm you. It's not going to help you. Now, before you decide that this is some attack on the CAPE, it was not meant to be. Okay? If I used CAPE to kind of illustrate a broader point, which is if you believe in mean reversion, these are dangerous times. These are dangerous times for two reasons. One is the amount of data we have and the periods for which we have them have expanded. I mean, we can go back to 1871 or 1802 with stocks, and we think that's good because we have more data. And it's true, because we have more data, we can derive more findings from that data. But unfortunately, because the data stretches back so far, what we find might actually be no longer relevant because we're in a world very different than the one that we got the data from. And that's true for emerging markets as well. Much of the historical data in markets like India or China reflect markets and economies very different than the market or economy you're in right now. Secondly, we have statistics on call. Statistics used to take work. To run a regression, you had to set it up. You had to do it yourself. Now it's one click away. And that's both good and bad. Good because we can churn out statistical correlations and regressions. And both academics and practitioners have used the statistical evidence to show that you can beat markets. As you saw just in this very simple example with CAPE, which has a strong negative correlation with 10-year returns, converting that correlation to actual money is really tough to do. Correlation is not cash in the bank. Converting statistical significance to investment returns is more difficult than it looks, and perhaps that explains a phenomenon that I've always struggled with. There are so many ways you can beat the market on paper, hundreds of ways, and there are so few people who actually pull it off. Maybe this exercise in trying to convert statistical significance into investment significance may help you understand why that happens. Thank you very much for listening.